Hey, everybody, it's your boy, Sean McLaughlin, at Options Sean on the old Twitter X. How you doing? Today is Wednesday, February 11, 2026. This is the What Are My Options show. This is where we basically have an open office hours about anything options related. If you have questions about options, options strategies, options execution, options trades, anything on your mind, I'll do my best to try to answer them for you. I see we got a question in the chat already. SM Traz, I see your question about calendar spreads. We will get to that. But before I do that, I want to talk. I wrote a little bit this morning. I don't know if you guys saw my email or saw the blog post, but I wrote a little bit about this morning about luck and the role that luck plays in trading. Now, I'm not going to sit here and say that luck is bad. Luck is good. I love getting lucky. All right. Lucky is great. Lucky is a big part of where profits come from in trading. But there's a difference between dumb, blind luck and luck that we've created. Okay. Dumb, blind luck would be like winning the lottery, right? You pick some random numbers and the numbers come your way and you got lucky and you win the lottery, right? Was there any skill involved in that? No. There's no skill. I mean, yeah, there's no skill. You're just randomly picking numbers. Or if you flip a coin 10 times in a row and it comes up tails 10 times in a row. Are you skilled or is that just dumb blind luck? I'll tell you that's dumb blind luck. But in trading, while we do get lucky from time to time, the difference is that we get lucky because we create our luck. We create our luck by having a process, having a method, and more than anything, just being persistent. All right. It takes persistence to have a setup that you like, put that trade on, have it lose 4 times in a row, and then step in on that 5th time and do it again. That takes persistence. Some might say stubbornness, perhaps, but I will argue it's persistence. Okay. You need to have a process and you need to follow it and you need to keep going with it, even when times are tough or things don't look obvious. We never know which setup's going to be the best setup. I'm sorry, my collar's all looking weird here. We never know which setup is going to be the big winner. I never know. I have hunches, I have feelings, I have hopes when I put a trade on, but I never know where big profits are going to come from. Okay. And so this feeling or this talk about luck is on my mind because luck just struck again today. And twice this week, luck has struck for me. So let's talk about the most recent one. Here's LSCC, Lattice Semiconductor. If you guys follow me on Twitter, I put a tweet out yesterday afternoon. I looked at this chart and I said, hey, this looks like a good $100 roll candidate. Stock's trading it was trading at 89 bucks at the moment. That was a fresh all-time high. And a stock at 89 bucks making a fresh all-time high to me is an automatic $100 roll candidate. That's a trade I will take 99 times out of 100. Okay? And so I did. I put on a call spread on this trade yesterday. Now, had I been a little bit more diligent, I might have noticed that they had earnings coming out later that afternoon. I don't know if that would have kept me out of the trade, but I didn't know that there were earnings, but that's immaterial. What matters is that I put this trade on following my process, thinking that this stock might have a chance to get to $100 over the next couple of weeks or couple of months. That was my thought. Did I know it was going to happen soon as the bell closed and they announced earnings yesterday afternoon and the stock would rip to 104? Did I know that? No, I had no idea. I am not a genius. I am not clairvoyant. I just know that there are things that I've seen, patterns that I've seen repeat over and over again, and I've made them part of my process to execute on those patterns whenever I can. Did I get lucky? Yes. Did I create my own luck? Absolutely. Here's another trade this week where luck struck again. Valiant or Valaris, excuse me, Valaris Limited on Thursday of last week. Similar story. The stock was making a fresh 52-week high. Again, a setup I love. Okay. When a stock's making a 52-week high, I love to be a buyer of stocks like that. That was a fresh 52-week high because, as you could see, we had been up there in early December, but we sold off, formed a little base here. And so on Monday, when the stock poked its head up above about 61 and a half, that was my signal to get in. I bought calls. Lo and behold, five five calendars later, 5 calendar days later, or 3 trading days later, this Monday, news hits the tape that Valaris is being acquired by Transocean, ticker RIG, at a premium, at a premium that's still being determined, but somewhere around where it's trading at now, around the mid 80s. Did I know when I put this trade on Thursday that Valaris was going to be a takeout target? I had no idea. No idea. But I put myself in position, following my process, following my repeatable things that I do all the time, taking the setups that I love to take, my favorite setups. I talk about my favorite setups all the time. My favorite setup is buying a stock making new all-time highs, right? That was the case in Lattice. Valaris was not a new all-time high, but it was a new 52-week high. That's my second favorite trade, right? Stocks making 52-week highs are all-time highs. I love buying those. And I did it here, and I got rewarded handsomely. I had long calls in Valaris. I sold it actually on Monday when we had the big gap because in my hubris, I thought that I had figured out what the actual takeover price was, and I thought, hey, it's trading there now. I should probably sell and just get out instead of holding this for another 6 weeks, which is what I had. Maybe I was early getting out, but either way, huge win on 3 trading days of risk. Huge win. And here's another example from earlier this year. Warner Brothers Discovery. Guys, I got into this stock when it was trading around 12 and change, about 12.50, I think, was when I started looking to buy this thing. Why? Because I liked this pattern. I thought it was breaking out of a consolidation, and it had new all-time highs in sight around 13 bucks. That was my signal. Did I know that literally less than 30 minutes after I got into that trade, I bought calls that expired, 6 or 8 weeks from the time I got in. There were October calls that I bought on September 11th. I bought October expiration calls. I think I bought the 14s. Did I know that less than 30 minutes later, news would hit the tape that Warner Brothers is now a takeover target by one of its competitors? And the stock just immediately ripped. Did I know that was coming? Of course not. I have no inside information. I have no connections in Hollywood. I had no idea that this was happening. If you're listening, CFTC or NFA, please know I had no idea. I was just following my process, buying a breakout, and the stock ripped less than 30 minutes after this thing just took off. And I got out of the trade for a monster win, one of the bigger wins I've had this year. Guys, luck is part of trading. Luck is where profits come from. Luck is where some of our biggest profits come from, but it's not dumb, blind luck. It's the luck that you create from having a process, having a system, and diligently following your process or system persistently, day in and day out, week in and week out. That's how you get lucky in these markets. And I love getting lucky. I am not ashamed of being lucky. Luck is how we win in this game. All right. So I'm going to get off my soapbox there. I wanted to get that off my chest. I see a few people here. I see Dan. I see Venka. I see Trevor. I see SM Traz. All right. So SM Traz, let's talk about the calendar spreads. He wants to know when I use them, and are they just to lower premiums? That's a good question. There are a couple of reasons why I will use a calendar spread. So for people who don't know what a calendar spread is, a calendar spread is when you have two options, either calls or puts. Let's talk about a call calendar spread. You have two options, same strike price, but different expirations. So you're short the near term option and long the longer dated option. So for example, we're in February right now. If I put a call calendar spread on, I might short a March call and buy a July call. All right. Let's bring up. Let's see. I got a few trades, a few calendar spreads on. No, I don't have them on in this account. But let's try something. Let's just create a calendar spread. We'll use Amazon. I'm just randomly picking Amazon. I don't have any special insight into Amazon. But let's say I'm putting a call calendar spread on. I would look into March options for my short option. Okay. We'll just do an at the money here. We'll do a 200 strike. Okay. So I'm going to buy a call calendar spread. I'm going to buy sell the 200s in March, and I'm going to buy the 200s in July. Okay. Now let's look at what this trade would look like in an analyze tab. Boom, boom, boom. Okay, so this is what a call calendar spread would look like. Let's get this, let's bring this here. Okay, so we're trading, right around 200. Yeah, we're trading at 203. Let's zoom out a little bit. Let's stretch this out. So call calendar spread, if I put a call calendar spread at the money, right, and we're using the 200 strike with Amazon trading around 200, a call calendar spread benefits from the short option decaying away in value faster than the long option. So if Amazon were to stay in this range between, let's say, 190 and 210, and I see this little thing down here at the bottom of my screen, I'm going to move the calendar date forward. As I move the date forward, you see the purple line there starts moving higher, starts morphing into that blue line. The purple line is the P&L across the range of prices today, or whatever date I have selected. The blue line is my P&L on expiration day. In this case, expiration day of the short options, which are March. Okay. So as we get closer and closer to expiration, the P&L curve starts morphing into the expiration P&L curve, and you can see my profits go up. If Amazon was still at this price, I did a one lot, I'd be up about 290 bucks. If this was the case on March 15th, which is about 5 days before expiration. Okay, let's just come back to today. Where are we? We are here. All right. So why do I put calendar spreads on? Well, first of all, a calendar spread is a type of spread that benefits from volatility expansion. Okay. So if we think that volatility is going to rise, a calendar spread could be a great trade. Why? Because when volatility rises, the option that has longer time to expiration, in this case, the long option, that will be impacted by the rise in volatility more so than the option that has less time to expiration, which is our short option. So the long option will gain value a lot faster than the short option will, which means our spread will make money. So if I think volatility is going to expand, I think a call calendar spread could be a good trade. If I think the market's going to go higher, and let's say Amazon's at 180 and I buy this 200 call calendar spread, I'm betting that maybe volatility will rise and I'll get the directional bias. I put calendar spreads on, I guess if I think about it, for three reasons. One, if I think volatility might rise, that's one way I could play a volatility rise. Another reason I'll put on a call calendar spread is because I want to lower my cost of participation. Maybe I want to buy these Amazon 200 July calls, but they're too expensive. Let's go back to the trade page here. The July 200 calls, if I were to buy them outright, are going to cost me about $2,200 per one lot. All right. Maybe I don't want to pay 2,200 bucks. That seems like way too much. Okay. By doing the call calendar spread, as you can see here, by selling the March against the July, the March costs about $1,000, $1,050, right? Subtract that from the 22 and it comes to about $1,150. So it cuts my cost in half, roughly in half. So I get to participate in a bullish bet. Okay. And then I have two ways to win in that. Either the stock closes at my strike prices or near my strike prices, in this case, 200, and I sell the spread for whatever it's worth when it gets there for profit, especially if it's a directional calendar spread. Or the stock just sits there around 200 and those short calls decay away, they expire worthless. And then I'm left with the long calls with theoretically unlimited profit, but I paid half of their price today, right? Their price is 22 bucks, but I paid 11.50 for them, right? So that's a one reason I'll do a call calendar spread, because I want to lower my cost of participation and hope that the short call expires worthless and I'm left with the long call. Okay. The other time I'll do a call calendar spread, and I don't do a whole lot of this, but I know some of us in the All-Star Options chat room do this. Another way I'll do it is if I want to exploit differences in the volatility structure of the option. So let's do this. Let's check this out. Notice how in my screen here, I got all the different expiration series. Okay, so we got weeklies and we got monthlies. And if you look on the far right side of the screen, you see these percentage values. These percentage values are the implied volatility of the at the money strikes at each expiration series. And you'll notice we got some 55, but then it gets 44, 33. We have different values here, right? And this might not be the best example here, but oftentimes, or not oftentimes, but when I will consider putting a calendar spread on is if I see in these short-term options, say in March, I see a 35% volatility in the March options, but if I go into like, I don't know, August, I'll see a lower value, say a 20%, right? So 20% in the long options and a 38% in the short options. If I put a calendar spread on, I'm betting on a convergence. I'm betting on the volatility of the short options either coming down and matching the volatility of the high of the long options. That would result in a profit for the trade, or the long options increase in value or increase in volatility to match the volatility of the short options. Also could increase the value spread. This is a little bit more advanced stuff. But you know, when there's a wide disparity in the volatility at different expirations, you can play the convergence of that disparity using a calendar spread. I don't do a whole lot of that. I do it occasionally. Sometimes around earnings, I'll do that. A lot of times you'll see a lot of juice in the nearer expiration options versus the longer dated options because people are just playing for earnings, right? And they're juicing up the premiums in the short-term options. It's something to think about. So those are the reasons I do calendar spreads. If I'm being honest, probably the biggest reason I do calendar spreads is mostly because I just want to reduce my cost of participation. There's a long option that I want to buy that has, you know, 3 to 6 to 9 months of expiration, but I don't want to pay full price for it. I'll sell another call against it to lower my cost of participation, creating that calendar spread. And that's the majority of the reason why I do call calendar spreads. I hope that answers your question. Um, do, do, do. Yeah, I mean, you had a follow up there, Traz, about you want to play call counter spreads to let a rally ride to do a breakout. Yeah, I mean, you could do them with leaps, absolutely. A leap, you could buy a long, you know, you could do any expirations, right? You could do a long term call that you want to buy, you know, with 12 months expiration. You could buy that, and you could sell a shorter term call against it at the same strike, and you could even, you know, potentially roll them every month, bringing in additional credit. But that's advanced stuff too, but you could definitely do that and nothing wrong with that. And a lot of people do that, and I do that from time to time. All right. Trevor asks, oh wait, hold on. Let me see. Let's go to Vinka. I have AMPX April 1321 bull call spread. Get out or hold. Thanks for your guidance. Okay. I'm not familiar with what AMPX is doing. So let's take a look. You got April. So you got what, 2 months to expiration. You're long the 13 bull, you're long the 13s and you're short the 21s. Okay. Well, I would say, I mean, look, the first thing I'll say is, what was your plan going in? I hope you had a plan going in. All right. If it were me, if I was in this trade right now, I probably wouldn't want to see this thing get below this 50-day moving average, which is right around 1025. If it breaks 1025, 1050, to me, that's a pretty bearish development. But that's just me. I probably would close the trade if it breaks, you know, what day was this? This is the 5th, so this was Thursday. If it breaks Thursday's low, that would probably be my signal to get out. But look, you have defined risk. Okay, I hope you size the position in a way that if you lost 100% of your capital in this trade, that it's no big deal. It's just, you know, 1% of your account, you know, somewhere in that neighborhood. If you did, then there's no reason to panic here. There's no reason to stress. But I would definitely have a level there that you pull the plug, and I think around 1050 is probably the level. That would be my 2 cents. All right, Venka. All right, Trevor, could you suggest a simple call option strategy to anticipate a breakout like Dow Chemical? So, I mean, are you asking for a trade in Dow, or are you looking for a trade like Dow? Dow is breaking out. I mean, a simple call strategy is just to buy calls, right? Depending on your time frame, if you are thinking to buy calls that have several months to expiration, generally I like to buy the 25 delta call, not always, but for longer term trades, I like to buy the 25 delta call because I think that gives me a nice balance between affordability because they're cheaper because they're out of the money, and leverage if I get it right. If I get it right, the percentage gains will be tremendous. I like it. So A simple call strategy is just to buy calls, buy the 25 delta calls, go 6 to 9 months out, depending on how much time you think you need for the trend. Pay attention to volatility. Okay. Down here, I got implied volatility on my screen. With the exception of a big spike here in volatility in April, like everything spiked. If you kind of map that out, volatility is at, it's kind of in the middle of where it's been since April, maybe at the lower end, which is relatively affordable. You want to buy calls, especially longer dated calls. You want to buy them when volatility is low because that's where you get the most bang for your buck. That's where you pay the least and can get the most gain if the trend develops the way you want it to. So if you're looking for a simple call option trade, whether it's a trade in Dow or a trade like Dow, find stocks that have implied volatility that is low, that is cheap, and then select an option strike that has 6 to 12 months of expiration. Buy somewhere in the between the 30 and 25 delta. Okay, if you guys don't know what I'm talking about here. Let's look at like the December options. Okay, I've got on my screen, I got a column here for delta. So right here, the 25 delta strike, you see 25 right here is the December 47 and a half. Okay, a 25 delta, for those of you who don't know, that means the stock, or I'm sorry, the value of this option will increase approximately 25 cents for every $1 move of the stock. Now, deltas change, right? They're not static. That's not going to stay at 25 delta forever. If the stock starts moving up and these calls get closer and closer to the money, they will accumulate more and more delta, which is great, right? For every dollar move that goes higher, you're earning more and more per dollar, right? Incrementally, you're getting more return, which is great. And conversely, if the stock goes down, you were losing 25 cents for every dollar stock goes down, but as it keeps going down, you'll lose less and less each time. So that helps you. All right. So delta is just, when I see a 25 delta, that just to me seems that speaks leverage, right? If I get this right, if I pay a dollar, let's say 75 for this call, and the stock starts ripping in my direction, I'm going to get the direction right. The delta is going to increase. The value of those options are going to increase, and my percentage returns can be tremendous if we get a big run. All right. So, who was asking that? That was Trevor. Yeah. Simple call strategy is to pay attention to volatility, buy when volatility is cheap, go as far out as you can or you're comfortable with, and maybe look in the 25 to 35 delta range just to get affordability and leverage. Okay, what else we have here? Richard says, Sean, your tweets are different than your Telegram posts. Well, Telegram is the All-Star Options chat room. Okay. So the All-Star Options chat room is held in Telegram, and that's just we're talking about All-Star Options trades. All right. Yeah, so they're different. My tweets are different. Two different venues, two different things. Yeah, of course. Randy asks, as a member of ASO, I did not get VAL or LSCC. Yes, these were not all-star options trades. I do a lot more trading than just what I do in all-star options. All-star options is one piece of my trading. That's more of my swing trading portfolio positions that I'm holding for, 2 to 4 months, 2 to 8 months, depending. I mean, obviously, if they're not working, they'll get stopped out quickly. But winners are held for 2 to 8 months. That's a different thing. I do other trading. I do all kinds of trading. And Val and LSCC were part of my own personal trading. I do put them on the subscription service that I offer on Twitter if you want to check that out. That's just for junkie traders. All right, it's not for patient buy and holders. It's very active. We do 5 to 10 new trades every day, most days, not every day, but most days. And we did those trades there. Okay, great info on calendar spreads. I'm glad that helped, Traz. And try one out. Let me know how it goes. I'd love to hear how that goes. WTVIK, good risk reward, and would you trade it, or how would I trade it? All right, Jackson, let's look at those trades individually. WT, wisdom tree. Yeah, this is a chart pattern that I definitely like. I would be patient here. I would want to see it I'd like to see it break above 17. It's forming a high flag right here, which I like. This is a pattern that I generally like. I would probably wait till it breaks 17 before I get in. I can maybe be more aggressive, and if it breaks this high from the fourth, maybe above 1650 if I wanted to be more aggressive. But I think for me, 17 is the level I would pay attention to. I don't know if this has I don't know if it has very liquid options though. Let's see if in March the bid-ask spreads are pretty wide. Like the at the money call right now is bid 100 or bid a dollar, offered $1.95. So it could be tricky from an options trading perspective to trade Wisdom Tree. Um, it's got a fair amount of open interest, but I mean, as you can see, these NAs, there's been no options volume at all on the calls or puts in March. We had a couple trade here in June, but not a lot of action here. So I don't know if I like this as an options trader, but as a stock trader, certainly I'd get long above 17. That would be a good trade to me. Let's see if Vic has something a little different. Vikings Holdings, Viking Holdings. This one definitely has options volume, I'm pretty sure, or enough. Yep, yep. Similar pattern. You guys know, I mean, if you know me at all, you know I love momentum buying. I like buying trends. I'm a trend follower. So this is certainly a strong trend off the April lows. If this thing kind of went back to into the green today, above 78, I think this could be a good buy. This would be something I'd be interested in. In fact, I like it so much, I'm going to set an alert for myself because I might want to buy this. If it gets above 78, I'm in. There, I set an alert. Thank you for the idea. Who was that? Jackson. Thank you for the idea. I may trade that. But yeah, I'd be careful with that WT. Didn't look like there's a whole lot of options volatility or volume there. Trevor, you're welcome. Okay, I don't see any more questions on there. If you guys have questions, hit me up. Sorry we started a little late. Steve had a show before this and went a little long. So we started a few minutes late. I apologize. We like to go about 30 minutes here. But hey, let me just circle back to that riff on luck. Ladies and gentlemen, please remember there's no shame in being lucky in trading. Being lucky is important. It's a very big part of what we do. Okay. Many of my biggest profits, I would argue, I was lucky, but I created my luck. All right. I created my luck by sticking to my plan, sticking to my process, taking the trades as they come, stepping up even when I'm in a losing streak or not feeling well or I'm too busy or whatever. I still step up and take the trade when I get the signals that I'm looking for. Okay. That's creating our own luck. All right. I see one question came in from Hollis Mobile asking about Corning. What is that ticker? What is Corning's symbol? Corning, GLW. I knew it was a weird one. Oh man, now that's a stock I wish I bought a few weeks ago. This is man, I don't know if I would buy it here. I think when we had this breakout, if you weren't already in when you had this breakout here on 127, that could have been a signal to say, okay, we got a breakout. Let's see if it holds. If it breaks above the opening price or, somewhere, yeah, let's just call the opening price of this day. Actually, no, not the opening price, the closing price, excuse me. So right around 110. If we come back and break above 110, maybe you get in here. So I would have maybe gotten in on this date, 2-3. I would have taken some heat for a couple days, but I don't think I would buy it here. I mean, that's just me. I don't want to chase. And you know what? That brings up another good point. I'll leave you guys with this point, guys. I wrote about this yesterday on my note. If you're not getting my free options letter, what are you even doing? Get my free options letter, okay? I share great stuff. I'm biased, but I share great stuff, all right? And yesterday I talked about stocks like this, GLW, stocks that have had big runs. And it's very easy to see a stock like that and have FOMO, fear of missing out. All right. Fear of missing out is the most destructive thing we experience as traders. Okay. Fear of missing out leads to chasing, leads to buying at the worst possible price and then getting the rug pulled on you very quickly because you bought it when it was overextended. Okay. But when you are feeling FOMO, and I'm feeling FOMO looking at this chart right now, I'm like, man, I wish I was in this thing. I should have been in this thing all along. What a great trend. This is my kind of trade, but I wasn't. I'm not in it. All right. Instead of beating myself up about it, I could use this chart and many like it as information. Okay. If I see Corning continue going higher from here, even though I'm not in it and I haven't bought it, that is very good information. That's telling me that there's still an appetite for risk in the market, that stocks that are extended are still going higher. They're not for me to buy, but they're for me to watch and observe. If I see that these stocks continue to go higher, risk appetite is still very much with us. And why that matters is because the next setup that I see in a different stock that has a fresh breakout, like for example, that Valiant I was talking about, when this thing broke out here, and I know that risk is being rewarded in the market, right? Stocks are extended and they keep going higher. Well, that gives me confidence knowing that, hey, there's appetite for risk out there. So I'm going to buy this breakout and feel pretty good about it. Did I know it was going to rip to 87? No, of course not. I did not know. I did not know this was going to be a takeout target. But knowing that I'm seeing these extended stocks like Corning just keep going, that gives me confidence to take the next trade in the next stock. Meanwhile, if I'm seeing stocks like that, fall completely over, like, I mean, if I'm watching deer right now, like this deer just keeps going. I'm not in it. I've been chasing it. I was chasing it when it was breaking out here in the 530 to 550 area. I kept trying to buy in here and I just couldn't get it. It kept running away from me. I was trying to be patient with my limit orders. I just couldn't get it. And so now I'm sitting here watching this thing and I'm just having FOMO. But I'm watching a stock like Deere and saying, hey, when this thing rolls over, that could be a signal that there's a regime change. We've seen a lot of money flowing into these consumer staples, right? And old economy stocks. If we see that dynamic shift, well, then that could be a signal. That could be a different, all kinds of signals. It could be a signal that now risk is going to start going back to the high beta names, the high tech names, maybe. But it definitely means something is changing and it's time to pay attention. Okay. So when you see a stock that's ripped as far as it's gone and you're feeling FOMO, don't let FOMO beat you up. Don't let FOMO lead you into a bad trade. Use that FOMO as information. Pay attention to those stocks that you missed and pay attention for their turns, not because you're going to trade them, but because that's going to be a signal for your next trade. Okay. All right. That's all I got for you, ladies and gentlemen. Thanks for tuning in to the What Are My Options show. We will be back next week. We may be back with a new time and day next week. We're talking about it, trying to move things around so we can make the schedules work for everybody. We may move it to Tuesdays. Stay tuned on that. But hey, have a great rest of your trading day. It's a bull market, Act accordingly. Take care. See you next time.